Hello, everyone. This is Jack Mannon, Director of Marketing and Communications for Builders FirstSource. Thank you, everyone, for joining us today. Without further ado, I'm going to kick it over here to Mike Farmer, President of Commercial Operations for Builders FirstSource. Mike?
Thank you, Jack. I'd like to welcome everybody to the Builders FirstSource and Zonda Market Intelligence webinar for April. I'd like to start off by thanking our vendor partners, manufacturers, and importantly, our builders for great partnership over the last year. We're starting off with another very interesting year in 2022, and we couldn't do it without all the partnerships, communication, and support for each other here. So really appreciate everybody's effort and continuing to work together to help keep our country building. Today, I'd like to thank our partner, James Hardie, and sponsor for today's event, and turn it over to Mike Patrick, who is the National Strategic Account Manager for James Hardie. Mike?
Yeah, thank you, Mike. Hello, everybody. It's an honor to speak to you today. I got to say, going ahead of Valley Wolf is like being the opening act for for the Rolling Stones. So don't worry, I'm just going to keep this about 120 seconds, and then we'll get on to the real talent you've joined for. Next slide, Jack. So as a consumer-focused brand built on beauty and durability, we have an abundance of resources dedicated to understanding what the consumer, which is your home buyer, what they desire, what they aspire towards in their home design. Through extensive research, there's a clear determination that architectural styles are evolving. Here's just a couple examples. According to an AIA home design trend survey, since 2006, the popularity of contemporary design homes has grown by over 50%. The other trend driving this shift is the increased demand for mixed materials and different texture options on the designs of homes. We are seeing this from starter homes up through custom homes, depending on the market. It's a trend that's here to stay. Next slide, please. The big shift we see are homeowners really demanding a mix of both modern and traditional elements throughout their house. This is the definition of transitional architecture. The most common example would be the modern farmhouse design, and that is incredibly popular, and that I'm sure you are familiar with. Based on our market research, transitional design continues to take a larger share from traditional design homes. The most common way to achieve this look on the exterior is to use mixed materials and textures to add more architectural lines. Next slide. So the question becomes, as a builder, how do I meet this potential need without disruptions or complications with my current trade labor and existing supply partners such as Builders FirstSource? We think the answer is the Hardie Architectural Panel, which was a winner of a Best in Show award at the 2022 International Builder Show. This integrated solution of panels and trims enables unique combinations of contemporary textures and architectural lines with the durability installation efficiencies you expect from James Hardie fiber cement. As a sidebar, we have a significant investment in production capacity that will come to fruition in 2022 and beyond to better support the demand for our products you're probably seeing now. Investments in new product innovation like this will continue to be a part of that investment as well. Next slide, Jack. So the shiplap joining system simplifies installation and provides sophisticated lines to yield contemporary design aspects. Examples of the finishes would be fine sand, mounded sand, and soon to come seagrass and sculpted clay, which all complement each other and add to our existing wood look materials to build the dream home your consumer or home buyer desires. Next slide. So I know that was quick, but thank you for your time. For more information, please go to our website to view the Hardie Architectural Collection and discover the full range of product options to make your dream home a reality. Thank you so much.
Thank you very much, Mike, and thank you to you and the James Hardie team for your sponsorship for today's call. Next up, I'd like to introduce Steve LaValley, who's our Vice President of Forest Products and Transportation. Steve?
Thank you, and thanks again, Michael, for your support of James Hardie, and not only this call, but also on BFS's entire business. Most on this call are well aware of the exceptionally volatile commodity environment over the last couple of years. Go ahead to the next slide there, Jack. On the screen here, I'm presenting a couple visuals that just show what's happened over the last handful of years. I think many people on the call are probably well aware of this, but what really goes into why is the supply and demand so tight? Well, we can see here on this slide here that the lumber consumption, represented by the red line, and the black line is lumber production, the same with OSB at the bottom. We've seen a trend over the last handful of years where the consumption has grown faster than the pace of production. There's many variables involved in that, but we've ended up in a scenario here where the supply and demand balance is exceptionally tight. Lumber and OSB are not the only product in this place, but certainly it's created an exceptionally volatile commodity environment. So we may look at it and ask, when do we think this dynamic may change? Well, we do believe that there's a little bit of production that comes online, but also as demand increases, I'm not sure how this balance really changes. And so one of the two questions we need to ask ourselves a question. The two things that need to happen to resolve this imbalance are going to be either supply needs to increase or demand needs to decrease. So hopefully Allie can shed some light on what she thinks that's going to do going forward, but maybe next slide there, Jack. So the question could be, is this stage of volatility, is this the new normal? Well, I think it's going to be a little bit too early to really say if this is normal or not. Hopefully, I think we all agree that this extreme volatility is painful on the business. We do think that there are some increases in supply coming. There could be some headwinds on demand, but that's a little premature, I think, to call that. But I would say that to expect continued volatility, certainly in the near term to midterm, until one of these two things changes. So going back to the word normal, so when we think about what normal looks like, we also need to consider the tendency of markets to gravitate towards the cost of production over time. Forest product commodities, though, I think we all need to challenge our historical assumptions around what this break-even level could be. Looking at the random length framing lumber composite chart, we can all draw our conclusions as to what normal may have been in the past. But moving forward, also think about the inflationary pressures that are currently in force. We get fuel costs, we get transportation disruptions, logistical challenges, wages, labor rates, inflation of raw materials, often in places that we rarely think of. Think of the MDI resin shortage of a year ago. All these things are tremendous inflationary pressures on the cost of production. When we start to think about what normal is, the one thing I'll leave everybody on the call with is expect this cost of production level to be higher than it was historically. Where it settles in, I don't know if we all know exactly where this inflationary spiral is going to end up, but safe to say it's probably higher than what it was in the past. I'll turn it over to, I believe, Scott Doyle is speaking on behalf of Jeff Rettig. Take it over, Scott.
Hi there. Good afternoon, everyone. Excited to be speaking with you here today. I would again like to thank James Hardy for putting this on. As Steve mentioned, I will be filling in for Jeff Rettig today on the building product side. So on our slide, we have some good news out there and some bad news. Unfortunately, the bad news is that we continue to see transportation challenges all throughout the industry. We have already been short around 70,000 drivers to this point, but now experts are starting to say that we're probably going to be closer to around 100,000 or over 100,000 by the end of 2022. We can see that pressure starting to mount when companies like Walmart are starting to throw around amounts of up to $110,000 for drivers in their first year. It's imperative to get them into the door in order to keep all the supply moving. To that end as well, we're now starting to see another added layer of complexity with fuel surcharges as the recent fuel costs have really started to skyrocket as well. And then to that point too, there's obviously no surprise in shortage of material. With that, we continue to see a large amount of pricing pressure. That's due to anything from shortage of raw materials and core materials that go into the products, as well as the transportation that goes into it. Additionally to that, just as the Walmart example, we're starting to see a lot more call for rising wages out in the field, and it's getting harder and harder to fill all those positions. With those increased transportation costs and all of those factors going in, I think we're going to continue to see that for some time now. Now for some of the good news though, we are going to start to see some additional production from suppliers in the second half. Second half of the year, One of those is going to be siding from our partners at James Hardy. We should start to see their production come on probably end of this year, which will be really helpful. On the decking side of the equation, AZEK's going to bring on some additional production as well, which should help there, and we should also see some in sheathing. So that's the update on the building product side, and I'll hand it back to Mike. Thank you all.
Great. Thank you, Mike, Steve, and Scott. Really appreciate the update and information there. Now I'd have the honor of introducing Allie Wolf, who is the Chief Economist from Zonda. Allie, please take it away.
Awesome. Thank you, Mike. And I'm excited to be back with you guys. There is so much going on, and I know we're all just trying to wrap our heads around this. So we have about 35 minutes that we're going to get through a lot of different content. But just real quick, as mentioned, I am Allie Wolf, the Chief Economist with Zonda. If you're not familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. We collect our data through a lot of different measures. We use satellite imagery. We have our advisory team that's going to office visits. We have 500 people in our research department calling new home communities across the country, surveys that you'll see today, and we're driving the communities as well. But while our proprietary data is on the new home side, of course, we have to look at what's happening in the existing home market, what's happening with policy, what's happening internationally. And so we're going to discuss a lot of those different trends, like I said, in the next 35 minutes, where we'll go through 5 sections. We'll start high level, look at what's happening in the economy, talk about housing, talk about the buyers, talk about the market challenge that we're running into today. And finally, we'll finish with our forecasts and final thoughts. Now, with the economic backdrop, I want to start on just one slide. We're going to spend a little bit of time on this because some of these topics I'm not going to hit on more, but we know this is part of the fluid backdrop that we have. And so the first is, of course, we have the war in Ukraine. And we never want to talk about what is happening in Ukraine without acknowledging the human life of it. But we also at Zonda are asked, what does this mean for the economy and for the housing market? And you'll hear me mention that a couple times throughout today's presentation. Another part of the backdrop is the volatility. When you look at the stock market, we have good days, we have bad days, and we always will, but the volatility has seemed to pick up since the beginning of this year. A little bit later, when we talk about the buyers, we'll talk about what the stock market, the current trends look like and what that could mean for overall home shoppers. Inflation, we're now at a 41-year high after the data that came out yesterday. And the challenge with inflation right now is a lot of economists and analysts believed that the overall level of inflation was going to come down as you start to see some relief on the supply chain. And that's still the expectation, but we know the geopolitical challenges, what's happening with Russia and Ukraine is making it a little bit more difficult to forecast inflation and also pushing out some of the timeframes of what was originally expected. Now, one of the categories influencing this is, of course, oil prices. So we are nowhere near the record high of oil prices. And in the past couple of weeks, we've come down from the recent high in oil prices. But what we've been through recently is that oil shock where we had the fastest jump in oil prices on record. So last I looked this morning, we were a little bit over $100 a barrel. What we know about the oil prices is that as that has gone up, some other inputs into the US have become more expensive. And then obviously, everyone is well aware of what's happening with the gas tank. And we just have to watch how high do oil prices ultimately go and how long do they stay there. Another part of the backdrop is that we have already seen about 3 weeks ago now, the Federal Reserve raised their short-term interest rates by 25 basis points. Note that I said short-term, different than mortgage rates, but we also have seen that recent spike in rates. And you'll hear me mention rates a few different times throughout today's presentation, providing context to it and then talking about what it means ultimately for the housing market. For now, it appears that we still have steady demand. We still have the homes that are market that are selling very quickly. But again, we'll talk about how we should be thinking about affordability and planning for affordability challenges. But I think one of the reasons we are still seeing some of that housing demand that's carrying on even with 5% interest rates is the idea that our labor market is exceptionally strong. So when you look nationally, we have 60% more job postings today compared to where we were before the pandemic. Companies are still trying to hire. And our national unemployment rate right now is 3.6%. And what I think is important when we look at the labor numbers is to look at the high income jobs. And the reason I say this is when you're looking at housing demand, obviously we're going to have buyers in all of these different categories. But to me, the high income job sector is one of those key components to track where are we seeing the most strength that is supportive of a strong overall housing market. The percent that you're looking at, we're comparing the high income jobs by market compared to where they were in 2019. We like 2019 because back then that was the lowest unemployment rate we had had in 40 years. So if you're at 100%, you've recovered all of those high income jobs. All of the markets that I'm showing you here are markets that have not only recovered those jobs, but have grown since then. Look at Austin, almost 120%. We know the same thing for Dallas, Raleigh, Jacksonville, Tampa, Nashville. You're going to start seeing these markets show up on the top of a lot of the lists. We know there's been migration there, second headquarters, companies just moving there, and that's contributed to the overall labor market and some of the strength in the housing market. Generally speaking, though, we know that in the economy, people that want jobs have jobs. And you heard Scott talk about the rising wages with Walmart. We're seeing wage growth basically across the sectors. When you look at wage growth, there's a lot of different ways to track this. I like the employment cost index. This shows that wages are up 4% compared to last year. That level of growth is the highest it's been in 20 years. So we now have this backdrop where we know there are a lot of people working. We know companies would like to grow more. They're just running into not having enough available labor. Because of that, we're seeing wages go up. We know people are willing and able to spend their money. We're seeing that across the economy. But we continue to run into these supply chain problems, not just in housing, but across the economy. And we have this supply and demand imbalance that's persisting. And that's why we saw, again, yesterday, the new inflation data came out, headline consumer price index up 8.5%. So that's higher than where we were the month before. When we're looking at inflation, if you don't remember, what we should be doing is averaging 2%. We're at 8.5%. And a really important takeaway from the economic backdrop is that the economy is so good. You can look at so many different measures and it will tell you the economy is really strong, but we're at a point that it's so strong that it's getting a little bit unhealthy. And we're trying to get it back to just this healthier pace of growth. And that's why the Federal Reserve has been really active in making a lot of changes. So let's step back. When we were meeting last year on this webinar, we were talking that, yeah, we think the Federal Reserve will raise rates. The Federal Reserve believed that they were going to raise rates 3 to 4 times this year. And then they came out this year, and we've already seen the 125 basis point increase. Federal Reserve says, hey, by the way, we think we're going to do 6 additional rate increases. And while a lot of people thought we were going to be doing 25 basis points, we may even be doing 50 basis points. So Zonda's house belief is that we will see a couple of those 50 basis point increases front loaded right now just to try to get some of that overall inflation under control. But there are a few things I want you to know about this. The first thing is that just because the Federal Reserve says they're going to do 6 increases does not mean they have to. If the market starts to slow, if they start to get to healthier growth, they may not go forward with all of them. The second thing, if you're looking at data, if you're looking at GDP data, job data, car sale data, even housing data, and it starts to slow, you have to keep in mind that that's intentional. An 8%, 8.5% inflation level is not good. Federal Reserve is intentionally trying to slow the economy to get us back to a better place. Now, here's the discussion point. What can happen, and many of you are probably familiar with these terms, is the Federal Reserve could have a hard landing or a soft landing. A hard landing is a recession. Now, the Federal Reserve does not want to cause a recession. Absolutely not. But what we'll talk about when we get to the housing section is in an economy that is so dynamic and moving so quickly, trying to make decisions based on a couple months of dated data can sometimes get you in trouble. And so the Federal Reserve is going to have to raise rates, watch the data is going to be lagged, and then oops, they may accidentally push it too far. Again, not their intention. They would love to execute a soft landing. This means inflation comes down. This means the financial markets don't freak out, and then we can just get back to a healthier path. Now, as we're looking at this, you may be asking yourself, well, you said the Federal Reserve raised interest rates 25 basis points. Why is it then that mortgage rates are up over 100 basis points? And the answer is what the Fed raising rates can do is tell you that you should likely expect mortgage rates to go up. The relationship between the two is not very strong. All you really can tell is if one goes up, the other goes up. It doesn't tell you timing or extent. And the reason is what's happening from the Federal Reserve is that they are influencing the mindset of investors. Investors are looking at where should I place my money, and they're aware that there should be 7 in total rate increases this year. We're going to start going through quantitative tightening, and what's happening in Ukraine is pushing inflation levels up. When that's the case, the 10-year Treasury has been on the rise. And as the 10-year treasury goes up, there's a near perfect relationship between a rising 10-year and the rising 30-year fixed rate mortgage, which is why there is that important distinction to understand what's happening in the economy, because that can directly impact what's happening to us here in the housing market. So let's shift to the discussion there. When we look at mortgage rates, one of the things that I track every single day is the 10-year treasury. And this morning, I think the good news is it's come down a little bit from where we were at those high levels. So hopefully we're going to get new data tomorrow on mortgage rates. It'll probably be around 5%. I got a quote from a lender just doing research yesterday, and he said 5%. But we're still expecting some volatility here. And what we see on the mortgage rate environment is that we have some people that are deterred by these rising mortgage rates. We'll talk about prices a little bit later. People are saying rates are going up, prices are going up, the market is still frustrating, I don't want to be involved. They're either stepping aside by choice, or I got a message from a lady yesterday who said she got quoted a 6% interest rate. That was the highest I had ever heard, but she was under contract, that she was picked for a resale. They quoted her 6%, she had to drop out. So some people are needing to drop out by force because of how high the rates have gone. But for other consumers, we know that they're motivated by this. They're saying, I don't want the monthly payment to go much higher. I want to lock in. Maybe some people already have a rate lock and they're trying to just find something to secure so that they can have a lower rate. And what we know, and this goes back to the challenges with real-time data, is that we've seen a mix of both, where some activity is still really strong, some activity has shown some signs of weakness. The most recent data we have is through March, so obviously we've seen some changes since the beginning of this month. But as we look at what we saw for March, we're looking at the average sales rate. Now let me tell you why we're looking at this. I could show you total existing home sales or total new home sales, but in a moment, I'm going to show you inventory. And if I show you sales numbers, we're going to see that some of the sales numbers are down, and that's a bit misleading because they're down because inventory has only gotten tighter over the past year. So what I like about the average sales rate is this is saying we don't care how many homes are on the market. If you're a builder and you're selling homes, how well are you selling? With a caveat, the fact that through March, we know 90% of builders were still capping sales. So this still isn't your perfect measure of the market, but I think this is a better market measure of overall demand. So March data is purple, March of 2019 is yellow. You can see basically all of the markets are still outperforming where they were compared to pre-pandemic levels. And some of these markets that are listed, Riverside, Las Vegas, Phoenix, Orlando, Jacksonville, these are some of our big migration markets. LA is a market that, sure, there have been some people that have left, but it's also a market that has been so undersupplied and so land constrained for so long that homes that are available on the market are still selling well. Now, like I said, I don't want to look at those total sales numbers, because if you look at new home community count, anywhere where there are 5 or more units for sale, the data continues to go lower, meaning more builders are still selling out of communities quicker than they can replace them. We'll talk about that a little bit later with land and lot development and when we expect that to turn around, but we know that's happening on the new home side, and we know it's also happening on the active listings side. That little mint color at the bottom is showing you the active listings for 2022. Now, part of this is a bit skewed by the fact that we still have a high percent of homes that are going pending within a couple weeks. And if they go pending within a couple weeks, they don't actually get captured in the active listings data. So I think this shows that the market's a little bit tighter than it is, but we also know, of course, inventory is tight on the resale side, partly because people have refinanced and they're choosing to stay put, and partly because some people would love to move right now, but they're just afraid that if they list their home and they sell their home, where are they going to go? And again, that goes back to how can new home market step in and supply some of these homes given the constraints that we have, and we'll talk about that in our forecast section. But I think we can all acknowledge that it is a very frustrating time to be a buyer, especially when we continue to see the level of home price growth. So we talked earlier about basically 120% of the high income jobs recovered in Austin. Then you can start to say, okay, well, it makes sense, I guess, that there's 50% home price growth across the market compared to last year. As you look down this list, Austin, Raleigh, Phoenix, Tampa, Dallas, again, these are some of the markets that we talked earlier about high income and linking them to migration. That data is for the resale side. We go into our Zonda database, we track all of the actively selling new home communities. We can look at what are we seeing in terms of new home price appreciation. And as you look at this, you can probably tell that the percentage growths are smaller than what you're seeing on the resale side. And that's because the new home market is susceptible to mix shift, what homes are on the market, and think about what product is changing, where are the locations changing. So that's going to impact the overall pricing. To adjust for this, I mentioned earlier that we also have our division president survey. We know 97% of builders that we talked to in March had raised prices month over month, 60% of which raised prices $10,000 or more. So we see that the price increases, again, this is through March, are still happening, and partly because of pricing power and the fact that there isn't inventory and you still have long interest lists, and partly because of the costs, the land costs that are so expensive, the labor costs that are more expensive, the material costs that maybe we've seen some relief and maybe there's a little bit more relief. But if you look at the year-over-year change, material costs are still a lot higher than where they were last year. When we're looking at this, so we're saying, okay, maybe some people are falling off on the margin, interest rates are making some people nervous, pushing some people into the market. We know that supply is still extremely tight, so prices are still going up. And then I think the important question is, well, who are the drivers of the strength, and how are those drivers ultimately holding up? And so if you've been on really any of my presentations over the past couple of years, I'm going to show you a slide that you have seen and you will continue to see from me, which is this matrix we created at the beginning of the pandemic. So remember why we did this. This was 2020 and we're like, what is going on? Geez, the market is so strong. And we said, well, let's sit back and acknowledge who's buying. First-time buyers, move up, luxury, second home, all of those different categories. Why are they buying? And last year, all of these different I guess this is 2020, all of these different categories would have checks over them. Yes, work from home. Yes, demographics. Yes, great home equity. Today, what I would say is 4 of these still have a very solid check. We still have some of the demographics we'll talk about. We still have that home equity. And I think the fear of missing out has only grown since then. The work from home, I would say, is a half check. Yes, we still have people that are working from home. Yes, that they're still looking to buy, but I think there was such a rush and a lot of people pulled forward that interest when the work from home was impacting them every day and the stay-at-home orders were in place across the country. And then there are a couple categories that I would say are probably still checks in today's market, but become a bit of a question mark. At what point do some of these tailwinds start to be headwinds? We have the stock market strength. Yes, there's a volatility. We have prices that continue to rise in a rising rate environment. So we're watching that, and we're watching what's happened as that increased savings. Remember that student loan forbearance runs off and people get back to normal everyday spending. But let's take some of those categories and let's dig into that. We're talking about rising mortgage rates. And you know, there are some shoppers that are incredibly sensitive to mortgage rates, and we'll show the math behind that. There are some shoppers who are just not that sensitive because they have other factors driving their purchase. And in some cases, you have people that are buying off of their wealth. And yes, we've seen the S&P 500 come down from recent highs. I think some people feel just a little bit more uncomfortable because it's not as strong, the portfolio isn't as strong as it was a few months ago. But looking at some of the longer term trends and saying, okay, well, what kind of wealth has people accumulated? S&P 500 over the past 5 years still up over almost 90%. So we see the strength in stocks that people are willing to tap that. Maybe it's not as big of a deal that you have to take on the higher mortgage rate. And then you have the equity, the average home equity compared to last year. And I want you to keep in the back of your mind, California, one of the highest at 117,000 over the past year, and Texas, 45,000 over the past year. I'll bring that up a little bit more later. Now, as we're looking at this, let's think about equity. Who does this impact? Well, if you're a first-time buyer, this stinks because you haven't been able to enjoy the run-up in prices. If you're a move-up buyer trying to move up within the same market, maybe you get a bit of a competitive advantage, but it's not that big of a deal. If you are taking out a cash-out refinance, which we know that has been increasing, this is important. If you're moving down, this becomes important. If you're moving further inland from the central business district, this becomes important. And if you're moving from one market to another, this is when it gets really impactful. And so I want us to think in the back of our mind that some of these wealth shoppers don't care as much about interest rates as some other buyers. So let's look at the migration. I love this data. It comes out once a year, and by the time it comes out, it's already dated, but it's the best data that we have to track where people are moving to. This comes from the census. The 2021 data is only through July 2021. So like I said, when it's out, it's dated. But you can track this over time, and this is showing you what markets in the country with a population of 1 million plus have more people moving in than moving out. You can look down the list, that's your top 10, and then the markets that are listed below would round out your top 15. Again, you see Austin at the top. Now we've said #1 for migration, #1 for high income job growth, and also #1 for home price appreciation. But you think about the buyers in a market like Austin. We've run the numbers. What is a like for like home? I think we're looking at a 22 or 2,400 square foot home. In Austin, it's 550,000. In the Bay Area, it's 1.5 million. Again, if you can tap the equity, if you're coming in and Austin still looks cheap despite 50% home price growth and consecutive at that, you can see how the market still has the ability to run even as we're starting to, I guess right now, the fact that it is still running despite having some of those headwinds. Then you look at demographics. And people that study the market are enthusiastic about demographics, and they should be, because right now, demographics are about as good as it gets. When you thought about forecasting, so many of us were saying, look at 2020, it's going to be a good year, even before the pandemic, just based on these numbers alone. The largest share of the largest living generation is between 29 and 32 years old, completely corresponds with when people typically start to get married, have kids, buy homes. Now, I mean the larger cluster of them start. Obviously, people have different choices of when those decisions are made. But when you look at millennials, we had this really interesting thing that happened in the data that I'm going to show you here. For millennials, I have done a survey every year for the past 6 years. And one of the things that we wanted to know when we started collecting the data is, if you're a millennial and you own a home, what size home do you want? And we wanted to use this as a way to say, you can build a smaller home. Millennials are totally fine taking a smaller home because they're trying to just get onto the home ownership ladder. So what we have for our most recent data, we collected this, I think we closed the survey in February of this year. 44% of millennials own a home under 2,000 square feet. Let me give you context. Before the pandemic, that was 70%. Now, before you go and say, wow, I think something went pretty wrong with your data collection this time around, because I know that's such a severe change, one of the important things is that when we talked about millennials, I'm thinking back to 2015, 2016, we were saying, when are millennials going to buy homes? When are they going to buy homes? And then we were at a point that going into the pandemic, the millennials were the largest buyer in the market. And so what this data is capturing is not that, partly some millennials are just buying larger homes, but a lot of this is that we don't just have first-time buying millennials. The pandemic really pushed that move to move up millennials. So now we're capturing who is buying an entry-level home, that's getting included here, but also the fact that we've had people that have moved further out, that have gone larger for their home size, they've bought a move-up home, maybe they've moved from a high-cost area to a low-cost area, and they've increased their square footage there. But I think this brings up a really important point. And as we look at millennials, and we're enthusiastic about this group, I think some are in that move up category. They're part of the wealth accumulation. They fall into some of the earlier positive factors I was talking about of the market. But then you also have a lot of the millennials that are first time buyers that are the most sensitive to affordability. They're trying to get into the market today, and they're really running into a lot of challenges, which is where I want to take the discussion to what I'm watching most closely. So when we do our monthly division president survey, again, this is through March, we had builders that were saying, we raised prices $25,000, $30,000, $40,000 month over month, and the home still sold within a few days, or our sales interest didn't blink. From our survey, we know 1 in 4 builders said that they aren't having any challenges in today's market. What we also know, though, is there's still some hesitancy from buyers, but most notably, we've seen a shift where builders are saying that they had people that were already pre-qualified, and because of the higher interest rates, they can no longer qualify, or buyers are coming in and they're enthusiastic, but they can't get qualified in the first place. And the top two quotes that I have shown here, I think are important to digest, which is, we significantly raised base prices and seem to have hit the wall with the buyer, or demand is good, but losing more people due to pricing. And so that 1/4 of the builders that say everything is fine, I think they're really catering to this group on the right. If you're a relocation buyer, we provided some of the math behind that. If you're a wealth buyer, if you're a move-up buyer, if you're an investor, this market works for you. It's frustrating, prices are going up, there are still some bidding wars, but it works. If you're a local buyer trying to compete with someone from Washington State, if you're a lower income buyer, if you're a first-time buyer, if you're just buying off of your paycheck versus your wealth, this market is very difficult to navigate. And you're always gonna have winners and losers in the housing market, but the spread between these two has really grown. And to me, it's provided some risk to the market. Now, we'll talk about what we're seeing on the ground and some possible solutions to this, but I just wanna go back to the discussion of mortgage rates. I kind of hit on, yes, they're up, yes, some people in, yes, some people out. But let's provide some numbers behind it. Now, if you were someone who was trying to buy a $450,000 home at a 3% interest rate, and you were totally capped out, that was the highest you could go for price, or I guess for payment. Interest rates went from 3% to 4%. The same payment for that buyer is a home at $400,000, not $450,000. Then you look at 5% interest rate. The same payment, you go from a $450,000 to a $350,000 house. And so this is, not everyone is totally capped out where they can't put another penny towards housing, but we also are acknowledging that that is the reality for some consumers. A 1% change in interest rate translates to a 13.2% change in home price. People may have to start compromising at this point. Do they move further away? Do they take a less good school district? Do they take an attached home? Do they compromise on something, maybe brand new? Maybe they have to have a home that in the resale market maybe takes a little bit of work. There are some compromises that need to go, especially we're in an environment that has the compound effect. Compound effect is something I've been presenting on for a while, and maybe I started warning about it too soon, but I kept saying I'm really nervous that interest rates are going to go up and home prices continue to go up. So let's look at the math. I'm going to use Houston just because it's the top market on this list. At the beginning of this year, 55% of households in Houston could afford the median price new home. Then we saw interest rates go up, home prices go up. You saw some of those buyers drop out. Where we are today is you went from 55% of households that could afford the median price new home to 45%. Now, before you ask, there is no number that I can tell you that, oh, if Houston gets to 40%, all of the market stops. There's no number. Look at Miami at the bottom of this table, 14%. Some markets can continue to do well with a completely different affordability number, but we do know that as both of those are going up, we are losing. At first, we started losing buyers on the margin, then you start cutting a bit deeper. So to me, this begs the question of how do we get to a point that the housing market is healthy, that we can cater to all different buyer groups, we can continue to see momentum moving forward. And so I go and I ask myself, what are builders planning to bring to the market? And we supplemented this with my question going out to the builders, and what we found is 70% of builders said that their new communities will likely be the same square footage of the communities that are on the ground today. You have about 20% of builders, a little bit under, that are saying that they're going to increase their square footage. I think partly because maybe they're catering to a higher price point, their buyers are asking for more space, and partly because they have to do bigger plans because they're limited by zoning restrictions. Then you have, again, a little bit under, probably more 13, 14% that's saying that their total square footage is going to decrease. And I want to go into this, but one of the common threads that we saw is the addition of more attached product to try to capture a wider range of the overall buyers. When we're looking at the market, I want to go back to detached. So consumer research shows consumers generally say they want a single family detached home. That's why we see it as generally the larger share of the market. We still have 78% of all of the homes, new homes that are being built today that are detached. Why I bring this up though is if you look at it by market, look at San Antonio, Austin, Houston, Lakeland in Florida, Sacramento, Columbus, Phoenix, Dallas. These are some areas that have had a lot of positive migration, and they're talking 93 to almost all of the product that is detached. And to me, this is the silver lining in a lot of the discussion, which is there's still the ability to make some changes to the product. Obviously, it's difficult to do. You have to work with the cities. I know there are so many things in the way of this, but to me, in some markets like LA, they've already done basically all of the design solutions, and they're trying to get even more creative. In some of these markets, in San Antonio, the creativity hasn't really had to hit yet. And I think that's still something that can be changed. Now, as we look at this, we have some builders that you talk to them and they will just say there is absolutely nothing we can do in our market. It's too late for entry level. Our prices have gone up, land, labor, materials, it's not going to work. But then as we looked at some of the other comments, there were things like, we're going to look at more higher density single family detached. So keep to the fact that we know consumers like detached. We're going to do more condos. We're going to do more ADUs, offer that. And we're going to focus on density and maybe do some different level of finishes. So there still are these different moves that are being done to try to adjust for how the market is evolving. And to me, what I think becomes important is as you're shifting the product, looking at some of that consumer research. Again, this is from our millennial survey, and we asked, what are the highest priorities in your next home? By the way, I'm doing a presentation on 55 plus in the next couple of weeks, and I'm working on that deck right now. The number one answer for millennials is a large kitchen. The number one answer for the boomers is a large kitchen and a nice kitchen. So you have the barbell of demographics saying, probably don't skimp on the area that I want to socialize in, that I spend a lot of time in, that really matters to me. You see another component is office room, which is tricky because obviously we're trying to talk square footage and price. But then look at backyard. We have an equal share of the millennials that we talked to that said they either want a big backyard or just give me a functional, a good backyard, somewhere that I can socialize, that I'm going to enjoy, but I don't have to have it huge, especially if it's going to impact the overall pricing. So let's go to the final section here. We have about 4 minutes left to go through forecast and final thoughts, and I want to start by acknowledging that we know more building can help in all of this because of the supply shortage that we talked about earlier. But it's very easy to say build more homes. It's very difficult to get more homes built, especially when we're looking at constraints across the board. So when we're looking at forecasting out starts, for us, we like to start with lots. We think lots becomes very important to determine if it's even feasible to get more homes built. Total upcoming lots from our database. That's any of those that have equipment on site, that are going through excavation or have road work in, up 26% compared to last year in the fourth quarter being the most recent data available. When you look at those total upcoming lots, you can distribute them by time frame, meaning 6% of the lots were in the streets in phase in the fourth quarter, which means they likely became available to builders via a vacant developed lot last quarter, in the first quarter. So 6%, we started to see more lots, started to see more vertical building. Then we have 25% in streets paved, which means this quarter that we're in right now, we're going to see more of those VDLs coming to the market, 70% in excavation. Available to the builder at the end of this year, available likely to the consumer towards the end of next year. We see that distribution matches up in most top markets across the country where you see it skewing more heavily towards that excavation phase. For us, this does mean that we expect to see more homes coming to the market over the next 24 months. For this year, we are calling for 5% growth in starts. And I found out recently that we are on the high end of overall forecasts. So for us, we're looking at the land and lot data to guide this, but also trying to pull back based on what we know with the constraints. If we don't see any relief on any of the different components, we obviously will be too high for this forecast. But as we look at the challenges, we did try to consider the fact that there are still government service problems, there are still land disruptions. Last year, this time, only 40% of builders said they had a labor shortage. Now we have 90% of builders and 94% saying supply disruptions. I know there's some early rumblings that maybe there's relief, but we still have through March, almost all of the builders saying this is an absolute big headache. And when you look at it by category, we asked the builders of these different groups, which one are you having no shortage, some shortage, or a serious shortage? Some, appliances, cabinet, HVAC. Serious, no surprise, garage doors, windows and doors, HVAC, appliances, cabinets. So we're looking at this, we're calling for 5.1% growth in starts. Again, maybe the risk is to the downside that we gave too high of a forecast for that. For sales, we're calling for 5.5% growth, contingent on the fact that we do see inventory go up a little bit. We know that some homes were built as specs last year become available to consumers this year, where that's pushing some of our numbers up. We think sales caps ultimately go down as the year progresses and the demand picture looks softer. Look at the context though, when we're calling for 5% growth, that puts us still below where we were in 2020. Ultimately though, we're watching affordability. That can be the wild card where you have that initial rush and then you see the market start to pull back. So instead of finishing with a normal forecasting slide and a summary, and Jack and the BFS team, this is my last slide. When we're looking at the market, I think we all can acknowledge that there are these challenges ahead that we need to be paying attention to. But I also think we in the industry need to remember why home ownership. We need to communicate it with our clients, with our sales teams, remembering to ourselves why there is that value in owning a home, especially in an environment where we have 8.5% inflation. A lot of people are looking at housing as that inflation hedge, lock the largest share of your monthly budget, and you can always refinance later if interest rates ultimately come down. But locking in now gives certainty, especially if someone can afford the overall monthly payment. For me, I'm not so eager to sell the homes to people that are just trying to enjoy the upside and pose some risk to the market. But if you have someone that's coming in and they're having a kid and they want to have a good school district and they're planning to stay there for a while, they're paying to themselves and you don't want them timing the market. I can't tell you how many people I know that have sold and they're waiting for the market to drop, and then we continue to see the prices move the direction they are. Plus, we know, going back to the inflation hedge and trying to lock in that payment, we know rents continue to rise. We didn't talk about it here, but when you look at rent growth, we still have rent growth that's double digits, matching, sometimes a little bit slower, but still rising a lot compared to the for sale market. So I think the final thing to think about is just remember to educate consumers on down payment options. I can't tell you how often I hear that people have no idea that you can do a low down payment option, or there's some shame in a low down payment option. Obviously, that's going to impact the monthly payment, which will be a question, but I think that's an important thing to keep reminding consumers. And also, if you're offering rate locks, rate buy downs, any kind of incentive to help people get their closing cost credits, we know that that can go a long way for some consumers that are just trying to get over the final push, and they're nervous about mortgage rates, and maybe they're looking for a slightly better rate. So with that, I know, BFS team, I ran 2 minutes long, so I am sorry, but let's turn it back to, I believe, Mike, and we can see if we have any questions. Thank you.
Allie, thank you so much, and great presentation as usual. I really appreciate all your insights, and I think I always learn something new every time I listen to you here as well. So, Jack, do you have any questions out there for the group?
Hey, thanks for asking. People are chatting me some questions here, so let me go ahead and get reading. All right, first question is for Allie. Allie, will rising interest rates reduce the number of resale homes and contribute to the lack of total available inventory? Seems like existing homeowners wouldn't want to pay a higher interest rate to move.
Yep, this is really important, Jack. So thanks for the question, or passing on the question. I think one of the things that many of you may have remembered from 2018 and some of the past times that we had rising rates is there's this fear of what's called the lock-in effect. And the lock-in effect is exactly what was laid out in that question, is when interest rates go up and you're an existing homeowner, why do you want to sell your home and reset the rate? So I think we absolutely should be paying attention to that. I think you could get to a point that people panic sell, they get afraid that maybe the market's slowing, and you could see, especially investors, change the overall inventory environment. But absolutely, rising interest rates do generally slow some of the transaction. I would say who doesn't get impacted by the lock-in effect would be your first-time buyers. But again, that goes back to the discussion of if we're trying to or needing to rely on more of our lower income shoppers, we need to make sure we're positioned in a place to acknowledge that as well.
Excellent, thank you very much. Next question. What are some of the first indicators that Zonda is watching that might signal a slowdown? Is it traffic, inventory, affordability? And do you have any market-specific examples currently?
Yes, so So I would say yes to all of the above that was laid out. So I think laid out was traffic. Absolutely, we're watching traffic, but in particular, we're watching conversions too. So is the traffic number good, but people are coming and then they're talking to their families or they're talking to their mortgage lender and it's not working. So conversion is one of the numbers that we would track. I would say cancellations, absolutely, we are tracking. And going back to the market example, we do a weekly update of the housing market in some markets across the country. And yesterday we just got new data for Denver yesterday, and we did start to see a little bit of an increase in cancellations. I would not say alarm bells increasing. It was still below 2019 levels, but we all know that cancellations were so low for so long, and just starting to see a little bit of a normalization in there. Just a couple other things I would say. We're tracking price cuts very regularly, and so price cuts don't necessarily mean that the market is coming down right away, but you're starting to see, I think that's an early sign that you can track every single day. I track it on Redfin all the time. Are consumers starting to push back? Days on market or homes not selling as quickly? That's a really important one that I'm looking at. And then ultimately incentives, just looking at what are maybe some of your competitors doing? Are they at a point that they're hitting that resistance and they're not selling homes that much? So I think there are a lot of different things that you can track in the market to give you that early sign.
Okay. Next question again for Allie. Which markets are the most vulnerable for an economic slowdown?
Yes. So I'm going to answer this without answering it. And the reason I'm saying that is we are literally in the process of working through this right now. And what we are doing, and we have some initial data on it, but I don't want to say the markets just yet, is we're looking at what markets have had, so we know this home price appreciation level has been really high, and we know it feels frothy in some markets. And so we wanted to say, can we justify the level of home price appreciation? Because to me, if you can justify it with fundamentals, there's maybe a little less risk than markets where you're looking at job growth, you're looking at the job base, you're looking at migration, and maybe all of those numbers are average to below average, but the home price appreciation is far above average. To me, that's saying there's something misaligned here and the market will be due for a correction. Looking for, like I said, it would be, for us, we're looking at the kind of confluence of all of those, but I'm not ready today to say which markets we have identified.
Okay. Another question for you, Allie. Do you expect a shift in home builder market share in the next decade? Will the scale of the national builders and institutional money in the build for rent category reduce the share of the small custom home builder?
Unfortunately, yes to both. Yes to A, yes to B, part of that question. And I would say when you're looking at the overall market share, I didn't show the chart today, but you can already track that this has been a trend that has been ongoing, but I think it's only been exaggerated because of the pandemic.
Okay, thank you. Next question is going to be for Steve LaValley. Steve, I got a question here, if you're still on the line, regarding, is there any forecast for lumber and when the market might catch up? If so, what is that forecast?
I like Allie's question, which is I can answer that without answering. I don't know if there's necessarily a forecast. There's all sorts of various things that are going to point in a direction. Lumber futures is going to point in a direction. FEA publishes a forecast. REFI publishes a forecast. And so I don't know if any forecast for me is going to be any better or worse than theirs. I think I'll kind of go back to my earlier slides and say my forecast is going to be for continued volatility because the rubber band is still stretched very tight. So I think we'll see periods that we see some downturns, but I also think the underlying demand is strong enough that we're going to bounce off these bottoms when they happen.
All right. Thank you very much. Another question for Allie. The last time we saw inflation this high, mortgage rates were in double digits. What could be different this time?
Oh man. What could be different this time? I don't have, I would say I'm a little stumped on this question. Jack, can you let me just think on this and go to another question, and I'll come back to it?
Yeah, absolutely. Okay, this is a question I've gotten multiple times here, so I'm going to ask it. What do you think the likelihood, Ali, is that we're going to see a recession in the next 12 to 18 months?
Eesh. You went from one bad question to another bad question.
I'm sorry. As a moderator, I'm giving myself.
I unfortunately, I think the risk of a recession has most certainly increased compared to where we were. And I think I would put the odds of a recession over the next 12 months maybe at 30%, and then you go higher as you go further out. The way that we look at it is there are some, I guess, early signs when you're looking at what could cause a recession or be related to a recession. We've seen obviously the spike in oil prices, but like I said, a little bit of that coming down, so that's good. You have the Fed changing policy, and so when the Fed changes policy, generally, like I said, hard or soft landing, a hard landing is more often an occurrence. And then we've seen some changes in the bond market. So I didn't talk about the sometimes inverted yield curve, but we know that what's happening with the yield curve can really influence what ultimately happens in the economy. Sometimes people say the inverted yield curve causes a recession, and I've had some conversations with banks that would kind of support that based on what I've heard recently. Some people just say that an inverted yield curve is your early warning sign. So anyways, I'm not saying it's 100% guarantee. We do have 3 signs that generally point that direction that are at least giving us a little bit of a, hey, just pay attention to the data as a trend.
Okay, next question here is about laminated veneer lumber. So this one might be appropriate for our supply chain team here. It seems LVLs are the biggest issue right now. Do we see that bouncing from one product to the next, or do we see LVLs being the consistent issue?
Jack, this is Steve. I'm not sure if Scott's still on the line or not, so I'll try it. I'm the lumber guy. I'm not the LVL guy, but I'll kind of speak to that a little bit. You know, it's difficult to tell. Certainly LVL seems to be the crux of many issues, but I think what we've seen happen over the last couple of years, as soon as the worst one starts to resolve, then we get to the second worst one, and then that one looks critical. And so it's kind of hard to say that. I think LVL, we're going to be stuck in this spot here for a little while because there's constraints on, you know, how fast the mills can ramp up additional production. You know, I think it goes back to the earlier question that came to me just shortly ago, when might the market catch up? I think on some of these things, you have to look beyond 2022, I think. I mean, I don't know what happens over the next 9 months that's going to resolve the supply side of things. Small incremental changes, but this is probably a 2023 scenario.
And I think that is pretty much bringing us to time here. So with that, I'm going to turn things over to Mike Farmer to bring us home and close the session. Mike?
Yeah, Jack, thank you very much. And thank you to all of our participants today in this webinar. And thank you to our team here at BFS for all you guys do every day. And looking forward to continuing to make this a great year. Thank you very much.